Hi there. The new 18% CGT rate for property sales in 2026 will catch many UK taxpayers off guard. This video explains the full calculation method so you don't overpay HMRC unnecessarily.
Hello there. If you're thinking about selling a business or maybe a property here in the UK, you really need to listen up. The next couple of years are, well, they're absolutely critical. The tax rules are changing, and honestly, timing is going to be everything. This whole guide was put together by the expert tax advisors over at My Tax Accountant, and it's designed to walk you through exactly what you need to know to get ready for 2026. Right, look at this number, £16,000. That is how much extra tax a small cafe owner in Manchester could end up paying on a £400,000 gain just by selling their business one single day too late. And the date that makes all the difference? April 6, 2026. Stick with me, and in the next few minutes, I'll show you exactly why that is. So here's our roadmap. First, we're going to tackle that 2026 tax cliff edge so you can see precisely what's changing. Then, we'll get clear on what actually counts as a business asset. After that, we'll uncover a really common property trap that catches so many people out. And then we'll run through the numbers, point out some costly mistakes to avoid, and figure out your next move. Okay, first up, what is this cliff edge all about? Well, it all revolves around a hugely important tax relief for business owners, and the window to take advantage of its best rates? It's closing, and it's closing fast. This timeline really tells the story. You see, before April 2025, the rate for this key relief was a tidy 10%. Right now, it's already crept up to 14%. But look what happens from April 6, 2026. It jumps again, all the way to 18%. That's a massive increase, which makes the date you sell your business more important than it has ever been. So what is this special relief we're talking about? It's called Business Asset Disposal Relief, or BADR for short. It's a name you really need to get familiar with. And you'll definitely want to hear this part because understanding if you qualify could literally save you a small fortune. Okay, so BADR, you might actually remember it by its old name, Entrepreneur's Relief. It was designed to reward entrepreneurs like you with a lower capital gains tax bill when you sell. Now, it does have a lifetime limit of £1 million in gains, but the real issue, as we've just seen, is that the government is steadily pushing that tax rate higher and higher, chipping away at the value of this relief every single year. So, who actually gets to use this relief? Well, over on the left, you've got those who typically qualify. Think of a freelance designer in London who's been a sole trader for a few years. They're in. Or a director selling their 5% stake in the trading company they work for. But over on the right, you see who misses out. And this is so important. It includes most landlords with a portfolio of rental properties. That's because it's generally seen as an investment activity, not a trading business. Now, it isn't just business sales that have these tricky rules. When we talk about residential property, there is a major tax trap that so many people fall into, even if they aren't business owners. This is one of those things that catches a lot of people out. 60 days. That is all the time you have from the day you complete the sale of a residential property to report the gain to HMRC and pay any capital gains tax you owe. It's not a year, it's not until your next self-assessment deadline, just 60 days. And this rule, it applies to almost any sale of a residential property that isn't your main home. So if you're selling a buy-to-let, a second home, or maybe a house you've inherited, this is for you. The only time it doesn't apply is if your gain is completely wiped out by other reliefs, like private residence relief. And you know, even though the deadline was increased from 30 days a while back, awareness about this is still worryingly low. And just to be clear, this isn't something you can just pop on your annual tax return later on. No, you have to use HMRC's specific online service. That means creating a government gateway ID, setting up a special capital gains tax on UK property account, and then submitting all your figures and paying the tax. It's a completely separate process you have to go through. Okay, let's talk about the numbers. I know, calculating your capital gains tax bill can feel a bit daunting, but the basic idea behind it is actually pretty straightforward. So let's make this simple. At its heart, the calculation is this. You take the sale price, and from that, you subtract what it cost you to buy and improve it. What's left over is your capital gain. Now, those allowable costs are really key here. We're talking about things like the stamp duty you paid when you bought it, legal fees for both buying and selling, and crucially, the cost of any capital improvements you made along the way. Let's go back to our Manchester cafe owner and see the real-world impact of that date change. With a $400,000 gain, selling before the deadline means paying tax at 14%, which is a $56,000 bill. But if they sell just one day later, the rate jumps to 18% and the bill shoots up to $72,000. That is a $16,000 difference just for being a day late. Now, let's look at a property sale. Let's say we have a basic rate taxpayer, their salary is £30,000, and they make a $50,000 gain on a rental property. First, they get to knock off their $3,000 annual exemption, which leaves a taxable gain of £47,000. Here's where it gets interesting. That gain gets added on top of their income. The first chunk of it fills up their basic rate tax band, so it's taxed at 18%. But the rest of it pushes them into the higher rate band, so that part is taxed at the higher 24% rate. Their total bill? Just over $10,000. So we know the rules, we know the numbers, but where do people actually go wrong? Stay with me here. This next point affects nearly every single small business and property seller in the country. These are the top 5 pitfalls. The most common one, hands down, is just missing that 60-day property deadline, which triggers automatic penalties. Another classic is forgetting to deduct all the allowable costs, like estate agent fees, which means you pay tax on a bigger gain than you should have. People also often forget to claim reliefs they're entitled to, or they assume their main home is totally exempt, which isn't always true if you've let it out or used it for business. And on that note, here's a brilliant tip straight from the experts at My Tax Accountant. They say, always keep meticulous records of all improvement costs. Many sellers lose thousands by failing to document this expenditure properly. This is so important. That new kitchen or extension you paid for can genuinely reduce your final tax bill, but only if you've got the receipts to prove what you spent. Right, with all of that in mind, let's turn to what you should be doing right now to get ahead of the game. It's time to start planning your next move. If you take one thing away from this, let it be this. For business owners who are thinking about selling, the clock is well and truly ticking. The tax landscape changes in a big way on April 6th, 2026. Acting before that deadline is going to make a substantial difference to how much you walk away with. Proper planning isn't just a nice to have anymore. It's an absolute necessity. And really, that brings us to the final question you need to ask yourself. Are you actually prepared for these changes? Because with rates going up and rules getting tighter, there's a very real risk that you could end up paying far more tax than you legally need to. Now, before we finish, I have to give you a quick but very important disclaimer. All of this information is for general guidance only. Tax rules are incredibly complex and they do change, so please don't rely on this alone to make any big financial decisions. For proper advice that's tailored specifically to you in your situation, we really do encourage you to consult with a professional. You can contact the team at My Tax Accountant directly using the details you see on screen. And for more updates like this one, make sure you subscribe to the My Tax Accountant channel on YouTube. Thanks for your time.